I have a confession to make. I love stealing investment ideas from some of the best investors in the entire world. For example, in Q3 of 2022, Warren Buffett bought a stock called Jefferies Financial Group. After studying this move Buffett made and digging deeper into the stock over the next few months, I decided the stock appeared to be undervalued and ended up adding it to my portfolio. Fast forward a few years later, and I'm actually up over 87% on this position. Keep in mind, we should never copy trades. Everyone has a different time horizon, risk tolerance, and goals, and even the best investors make mistakes. But looking at the moves super investors make can be a great place to start finding investment ideas. So in this video, we're going to be looking at the top 10 most frequently bought dividend stocks by super investors in Q2 of 2024. To analyze these stocks, we'll be using my automated spreadsheets from tickerdata.com. And if you want to get a free spreadsheet of the 50 most frequently bought dividend stocks by super investors, then you can do so at the link in the description. Now let's jump in. Now, before we start looking at this top 10 list, I want to look at some key stats surrounding the stocks that are in the top 50 most frequently bought dividend stocks by super investors. And I did some insights into this and we found some interesting takeaways. We can see the number of stocks with a 1% yield or more was 32. So again, we're looking at a list of 50 stocks. So that means there's 18 different dividend stocks with a yield below 1%. We can see when it comes to 2% or more, we had 16. When we start to get to higher yielding, around 3%, there were 10 different stocks that yielded 3% or more, and then we had 6 pretty high yielding stocks at 4% or more. Now, here's what's really interesting. We can see super investors have a huge bias towards dividend growth stocks. Well, how do I know this? Well, we can see the average payout ratio of these top 50 most frequently bought dividend stocks was around 35.25%, while the average total dividend growth over a 5-year period. So that means on average, from 2018 to 2023, these dividend stocks increased their payouts on average by 74.29% over a 5-year time period. So that is a lot of dividend growth in a very short time period. We can also see things in our sector overview. Technology stocks were frequently bought, financial services, the same is true, and then consumer cyclical. In fact, those made up the majority of the buys, and we can see industrials pretty high as well at around 7. And then finally, we can also see super investors have a bias towards high quality stocks. How do I know this? Well, one of the key indicators of a high quality stock is looking at the return on invested capital. And the average return on invested capital for the stocks in the top 50 list came in at about 24%. Keep in mind, generally speaking, 10% return on invested capital is considered decent. We can also see the median ROIC sitting at 18.9%. And if you want to learn more about why return on invested capital is such an important metric, I actually put out a short video the other day. I'd highly suggest you go check it out. It is a very in-depth breakdown. But again, we can see super investors have a bias towards high quality dividend growth stocks. So let's go ahead and start looking at the top 10. Now we can see coming in at the number 10 position, we have Google, a pretty popular stock, but a lot of people don't recognize it as a dividend stock yet. But we have to keep in mind, earlier this year, Google initiated its first ever dividend payment, but they also announced with it a massive buyback program, $70 billion buyback. Now, if we jump over to Seeking Alpha, we can see Google in the past year is up around 11.88%, but year to date up around 7.96%, which is actually underperforming the market. Now, if we look at them from a dividend perspective, I'll jump over to my dividend breakdown sheet. And again, you can download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets. It allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com, link in the description. But if I come over here and plug in GOOG and hit enter, we can see the data is going to load in, but there's not a lot to look at because historically, again, they haven't paid a dividend payment. But we can see that annual dividend will come in at about 80 cents per share, giving them a starting dividend yield right now sitting at just 0.52%. Now, because this is the first ever dividend payment, we don't really have a lot of insight into what management's plan is as far as dividend growth. But here's what we do know. The dividend growth potential is absolutely massive, and let me show you why. First off, look at the free cash flow growth this company's seen over the past decade, and especially the past 5 years. The past 5 years alone, the free cash flow CAGR is 24.93%. So look at this. 2018 free cash flow for Google was sitting at $22.8 billion, and in 2023, it's all the way up to nearly $69.5 billion. So that is massive growth over just a 5-year time period. But here's what else we have to understand. If we jump over to my balance sheet breakdown sheet and plug in Google stock, we're looking at the data as of the end of 2023, which is close to when they initiated that first dividend payment. Now, why would they do this? Why wouldn't they just reinvest more back into the business? Well, one of the things we have to understand is when a company can't intelligently reinvest all their capital back into the business at high rates of return, then it's time to start paying out a dividend. And what we can see is Google was a company absolutely drowning in cash. Look at the debt to assets ratio. It's just 0.07. The company essentially has no debt compared to its total assets. Total debt is $28.5 billion, while total assets is over $402 billion. And this isn't all just long-term assets. We can see total current assets sitting at $171.5 billion, giving them a very healthy current ratio of 2.1. Again, keep in mind, we want to see that current ratio above 1.0, meaning all of their total current assets can meet their short-term obligations. So their balance sheet is in a great position. Now keep in mind, with Google stock, there are some potential headwinds looming, such as the antitrust lawsuits. But overall right now, I believe Google is trading at a pretty good value. The second stock on our list is one that I think will have a lot of people excited, and that is Starbucks Corporation. This is a stock that's been heavily talked about over the past few months in the dividend investing community, and they've seen a lot of headwinds over the past year. They've had some pretty poor earnings reports. But again, this was the 9th most frequently bought dividend stock. And if we jump over to Seeking Alpha, we can see they're finally in the green for the year. They're up around 2.68%. But they had a really poor earnings report here in late April that drove the stock price all the way down to around $72.5 per share, and it traded in this low range for a very long time. But then we had the news of them hiring the Chipotle CEO, and the stock price skyrocketed all the way up to around $93 to $95 per share, and the company's now trading at $98.22 per share. So if we look at the past month, the company's up 26.5%. This is actually a company I added a few shares of to my portfolio when they were trading in this low 70s range. But let's go ahead and look at them from a dividend perspective. Again, we'll come up here and plug in SBUX. And what we can see is this is a company with a starting dividend yield sitting at 2.32%. So again, like we mentioned earlier, this is one of 16 stocks on this top 50 list that has a yield of 2% or higher. But we can also see the dividend growth has been really good over the past decade. 15.28%. That is phenomenal dividend growth over the past decade, and now it's slowed down a little bit over the past 5 years, but honestly it's still really good, coming in at about 9%. So we can see in 2013 those dividend payments were about 45 cents per share, and in 2023 it jumped all the way up to $2.16, and as of right now $2.28. Now as of 2023, the free cash flow payout ratio was sitting at about 66.17%. So it's climbed a little bit higher than I'd like to see it, but they still have a decent amount of capital left to reinvest back into the business. For example, in 2023, we can see free cash flow generated sitting at about $3.67 billion, while dividends paid out sitting closer to about $2.4 billion. If we jump over to our stock screener sheet and plug in the stock ticker for Starbucks, and this data will load in. Now, we can see there are some good aspects here, but there's also some concerns. First off, revenue per share does look pretty good over the past decade, going from around $10 per share all the way up to around $31.37 per share. We can see the company's bought back a lot of shares over the past decade, boosting all the other per share metrics. Now, debt to assets ratio has climbed quite a bit higher, but I think it is sustainable still as of right now, but I don't want to see it go much higher. But we can see the big concern for this company was revealed in the most recent earnings report. First off, we can see we're looking at Q3 North American segment results, and they've really struggled in North America over the past few quarters. We can see declines in change in comparable store sales, decline in transactions. Now, ticket prices are up a little bit, but it's really not enough to offset the change in transactions. And then perhaps what's worst of all, in my opinion, is we're also seeing declines in the operating margins. That's a pretty big concern for me, and if we scroll down even further, we can see the international segment results. The change in operating margin was even larger. They reported 15.6% operating margin when last year at that time it was 19%. So there's definitely some work here to be done for Starbucks. Keep in mind their next earnings report will be coming up on October 30th during market hours, so that's something I'll be watching very closely. The 8th stock on our list is Salesforce, and this is a company I actually haven't really talked about very often on the channel before, but this is another low-yielding company, actually yielding below 1%. But we can see over the past year, they're up around 11.41%, and if we look at them year to date, they're actually down around 4.61%, which I think some people believe leads to a buying opportunity. If we go ahead and look at them from a dividend perspective, and we can see this is another company with not really much of a dividend history. Low starting dividend yield sitting at 0.64%, but we are starting to see more of a trend of these big tech companies that are generating loads of free cash flow to start paying out dividends. We have Salesforce, we have Meta, we have Alphabet, which is Google's parent company. All of them have decided to start paying out dividend payments. It's a pretty interesting trend. If we jump over to the stock screener for Salesforce, there's actually quite a bit we need to point out. First off, revenue per share has grown pretty tremendously during this time, going from $5.41 all the way up to $31.60, and free cash flow per share has spiked up quite a bit as well, going from 99 cents per share all the way up to $6.36. But we also have to understand they have been massively diluting their shareholders. Look at the shares outstanding during this time period. In 2013, shares outstanding was sitting at about 563 million, and at the end of 2023, it jumped all the way up to 992 million. So if you are a shareholder, you have to understand you are being diluted. Now, it's not necessarily something you want to see, but that doesn't mean it's a bad stock per se. If we look at the profitability sheet, we can see they have a very high gross profit ratio, sitting at about 73.34%, and it's been consistently high over the past decade. Number 7 on our list is one that's had a pretty interesting past decade, and that's Disney. Pretty interesting from a political standpoint, a share price appreciation standpoint, and a dividend perspective. If we look at them in the past 10 years, they're actually down by about 1.76%, which is obviously pretty bad, especially when you compare that to the S&P 500 during this time period. Now, at one point, they were trading as high as around $197 per share, but they've come all the way down to $88.89 per share. So if we look at the past 5 years, down around 35%, but over the past year, it looks like they're up around 6.23%. If we look at them from a dividend perspective, here's what we can see. Low starting dividend yield, sitting at 0.84%. But what else we can see is this is actually a company that suspended their dividend payment when 2020 hit. Before that, in 2019, they paid out $1.76 per share, which is more than double than what they're paying out right now. And they just recently brought back that dividend payment, we can see. In 2023, they paid out about 30 cents per share, and again right now, sitting at about 0.75%. And when you look at the free cash flow versus dividends paid out, it becomes pretty evident why the company had to suspend their dividend payments. Look at this. In 2019, the company generated around $1.7 billion in free cash flow, but the dividends they paid out was sitting closer to $2.9 billion. That is not sustainable. Again, I preach this all the time, but there are 5 different things a company can do with free cash flow. They can reinvest back into the business, they can buy back shares, pay out dividends, they can pay down debt, or attempt mergers and acquisitions. So in the case of 2019, Disney used all their free cash flow to pay out dividends, and then they had to also dig into their cash pile or use other sources. Now, I'm not on the management team at Disney, but I'm pretty sure that's not exactly what the management team wants to happen. So we can see in 2020, they suspended that dividend. We can see it was quite a bit lower than it was in 2019, and then they didn't pay out anything in dividends for the next few years. So again, they're trying to get their free cash flow back to where it was pre-2019. We can see it was as high as around $9.8 billion at that time. The 6th most frequently bought dividend stock by super investors was stock ticker HUM, and that is Humana. This is a company in the healthcare industry, and this buy is actually pretty interesting. It has me wondering if investors are looking to buy the dip, because look at them in the past year. They're down around 30.43%. Now again, if we look at this company from a dividend perspective, again, we're looking at a lower yielding company at about 1.09%. but really good dividend growth and good free cash flow growth. We can see a history of dividend growth. It looks like there's a little bit of a slip up here in 2016, but overall, if we look at this over a 10-year time period, the 10-year dividend CAGR is sitting at about 12.3%, which is obviously very good, and the 5 years good at about 10%. They're also having to use very little of their free cash flow to pay out dividends, leaving plenty of capital left over to reinvest back into the business, driving future free cash flow growth. And if we jump over to our profitability spreadsheet, we can see this is another company with very, very high margins. Look at this, the 2023 gross profit ratio, 87.6%, which is even slightly higher than what the 10-year average has been for this company. If we look at the revenue versus cost of revenue charted out over the past decade, there's been a ton of growth, going from $41.3 billion in revenue in 2013 all the way up to $106 billion in 2023. The 5th most bought dividend stock on this list was one that actually really surprised me, and this is a high yielder, and it's CVS Health Corporation. This is a healthcare stock, pays out a $2.66 dividend, and their starting dividend yield is close to 5%. It's sitting at 4.76%. So if we jump over to Seeking Alpha, we can see in the past year, they're down around 17.54%. And if we zoom all the way out over the past 10 years, they're actually down around 30.33%. Now keep in mind, this doesn't include dividend payments, but still overall, that's not something you want to see. So if we jump over to the dividend breakdown sheet and look at CVS, here's what we can see. Yes, high starting dividend yield, like I already mentioned, and the free cash flow payout ratio has actually been relatively low over the past decade, sitting at about 30%. So we can see this charted out with the free cash flow versus dividends paid out. That dividend has been easily covered by free cash flow over the past decade. Now, one thing to take note of when we look at the dividend history for this company, we can see from 2017 to 2021, it looks like they kept their dividend payments stagnant at about $2, but over the past few years, they have been increasing those dividend payments to give them a 5-year dividend CAGR of about 5.87%. The 4th company on this list is one I would consider a quality compounder, and that is MSCI. This is a company that operates in the financial services, and this is one of the lower yielding stocks, as we'll see here in a moment, but over the past year, they're up around 6.14%, but we can see there was a time where they were trading as low as $464 per share. Now, when the company had the huge dip in share price, this is actually something I was talking about over on my newsletter. At that price, the company appeared to be undervalued, and like I mentioned here, it's basically pretty high quality with high levels of return on invested capital. Let's go ahead and take a look at that. If we jump over to my stock screener, we can plug in MSCI, and everything I see here is an indicator that this is a quality company. Look at the growth of revenue per share, free cash flow per share, and earnings per share. Not only is it growing rapidly, but very predictably and very consistently. We can see they bought back a ton of shares over the past decade and very, very high levels of return on invested capital. In 2023, it was as high as 30%. That is absolutely phenomenal. If we look at this company from a dividend perspective, again, we're going to see signs of a high quality company. The starting dividend yield is low. Yes, it's sitting at about 1.15%, but look at the dividend growth over the past decade, going from around 18 cents per share now all the way up to $6.40. They have a 10-year dividend compounded annual growth rate of 43% and a 5-year dividend compounded annual growth rate of 20.5%. And this is made possible because the company is generating such high levels of return on invested capital and they're reinvesting so much back into the business. Look at how the free cash flow has grown over the past decade, going from $276 million now all the way up to $1.14 billion. They have a 10-year free cash flow CAGR of 15.25%, a 5-year free cash flow CAGR of 15.23%, and they still have plenty of capital left to reinvest back into the business with the free cash flow payout ratio sitting at 38.51%. This is a company I would consider adding to my personal portfolio at some point in the future. The third most bought dividend stock by super investors on the list is Apple, and again, this is a pretty low yielding company, so it doesn't get a lot of dividend investors excited, and that's completely understandable. The starting dividend yield is sitting close to about 0.45%, but this is a high quality company still, even if its best growth days are behind them. We can see in the past year, they're up around 23.72%, and the past decade, obviously up big time, 780%. Let's go ahead and look at them from a dividend perspective. And one of the things we'll see is, yes, low starting dividend yield, but the dividend growth has actually not been as good as you'd expect despite the low starting dividend yield. So how is the company using their free cash flow? Well, obviously, yes, they are reinvesting back into the business, but also if we look at our stock screener, we can see Apple has a huge focus on stock buybacks. Look here, this is pretty impressive. 25.9 billion in shares outstanding in 2013. And at 2023, it was all the way down to 15.7 billion. So share buybacks have been one of the highest priorities for this company. And we have to keep in mind, earlier this year, Apple actually announced one of the largest share buyback programs in history at 110 billion. So keep in mind, yes, they do pay a dividend, but it's not growing as fast as you'd expect because the focus for this company is on buying back shares right now. The other thing I would want to quickly point out is this is a very high quality company. How do we know this? Again, look at the return on invested capital. This is telling us how profitable are the projects that Apple is reinvesting back into. And right now, they're very, very profitable. 2023 ROIC at 52%, 54.6% in 2022, and in 2021, 47.3%. That's pretty impressive. It's no wonder Warren Buffett has this as his largest position. Now, the top two most frequently bought dividend stocks by super investors are really exciting to me personally, and I'll go ahead and tell you why for the second one. We can see it's Microsoft Corporation. This gives me a lot of confidence because Microsoft is actually one of the largest positions in my personal portfolio. In fact, other than the dividend growth ETF SCHD, which is the largest position in my portfolio, Microsoft is the largest individual stock in my portfolio. It makes up around 7% of my portfolio, and I currently have around $14,000 in capital invested. If we blow up my growth chart, we can see the end results have been pretty good thus far. I'm currently up around 60% on my Microsoft position. If we look at Microsoft in the last year, they've done very well, up close to around 25%, and year to date, currently up close to around 12%. If we look at the company from a dividend perspective, we can see this is another low yielder sitting at about 0.71%, but the dividend growth has been pretty good over the past decade at over 10%. We can see very low free cash flow payout ratio with very nice free cash flow growth over the past 5 and 10 years. And keep in mind, this company has been around for a while, and the fact they're still able to grow at this rate is pretty impressive. Microsoft is basically a portfolio of lots of small businesses all in one, and in my opinion, that is one of their competitive advantages. If we look at the stock screener for this company, plug in MSFT, I think you're going to like what you see. As an investor, I love to see growth, but I also love to see consistency and predictability, and that's exactly, again, what we get with Microsoft. It's like what we saw with MSCI. Predictable and growing revenue per share, free cash flow per share, and earnings per share. We can see they have bought back some shares outstanding, and the debt to assets ratio is all the way down to around 14.5%, so the balance sheet must be pretty healthy and very high levels of return on invested capital, and it's been above 20% since 2019, so 5 consecutive years of return on invested capital above 20%. If we look at the profitability sheet, what we can see is double-digit revenue growth over the past 5 and 10 years, and the same is true with net income. We can see very high and consistent gross profit margins. And then finally, if we take a look at the balance sheet, we can see everything seems to be in a very healthy range. The current ratio well above 1. Keep in mind, we want to see this above 1, meaning total current assets can cover total current liabilities. And then the debt to assets ratio looks very healthy at 0.15. So total assets is way higher than the company's total debt. So this company checks all of my boxes. We can see balance sheet is healthy. We can see top and bottom lines are growing, and we have a lot of signs that this is a very high quality company, including return on invested capital. So when I think about the term goal for my portfolio, I want to one day be able to live off of my dividend payments. So while the starting dividend yield is low, I can feel confident this company will be able to increase their dividend payouts at a high rate moving forward for a very long time, which is great because I have a long-term time horizon. And then coming in at number 1, this is another stock I'm very excited to see on this list, and that's United Health Group Incorporated. Now, the reason I'm so excited that this stock is on the list is I actually made a video about 5 months ago talking about why I was adding this stock to my portfolio. So if you want to learn more about the company, go check out this video here. But also, this is the second quarter in a row that UNH was the most frequently bought dividend stock by super investors. And we can see over the past 5 years, they've more than doubled their dividend payment. That's really impressive. If we jump over to Seeking Alpha, we can see over the past year, they're up around 21.88%. But at one point, they were trading as low as around $440 per share, so there were definitely some buying opportunities right here, as we'll see. We jump over to our dividend breakdown sheet, and what we'll see is pretty much a picture-perfect dividend growth stock. The starting dividend yield is okay, sitting at about 1.44%, but the dividend growth has been phenomenal, backed by free cash flow growth. With a low free cash flow payout ratio, look at this chart. This is exactly what I love to see. Dividend payments going from $1.05 all the way up to $7.29 in 2023, up to $8.40 this year. We can see a 10-year dividend compounded annual growth rate of close to 20%, in the 5-year, 15.2%. And again, always remember, in order to grow dividend payments, a company has to grow their free cash flow. And this dividend growth is backed by growing free cash flow, as we can see with our free cash flow versus dividends paid out. 2023 free cash flow came in at about $25.6 billion, while dividends paid out was sitting at $6.7 billion. So the free cash flow payout ratio was just sitting at 26.3%. So only 26.3% of their free cash flow was being used to pay out dividends. If we jump over to our stock screener, again, we can see signs of a high quality company. Growing revenues, growing bottom lines with earnings and free cash flow per share, debt to assets ratio in a healthy position, and very stable and consistent levels of return on invested capital that's averaging close to around 15 to 16%. That's a pretty healthy range. So again, as a UNH shareholder, I'm very excited to see this company on the list for 2 consecutive quarters. So there you go, those are our top 10 most frequently bought dividend stocks on the list. We can see we have quite a few stocks on this list that have been rapidly increasing their dividend payouts, like UNH. Microsoft, MSCI, has grown their dividend payment over the past 5 years at over 183%, Humana at 80%, and Starbucks at 68%. The majority of the companies on this list also have high levels of return on invested capital, but on the flip side of things, we have a few I'm also surprised to see. We have companies like Disney, companies like CVS. I think these are pretty interesting moves. And again, I never recommend copying anyone's trades. You need to do your own research and decide what's a good fit for you and your risk tolerance and your goals. But lists like these can be a great place to start looking for ideas. And again, if you want to get a spreadsheet with the complete list of 50 top most frequently bought dividend stocks by super investors in Q2 of 2024, then you can get it at the link in the description. And like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.